Good afternoon, everyone. Thank you for attending our industry webinar. First of all, I'd just like to mention a few housekeeping points. We've muted you as you have joined the webinar, but if you could please remain on mute so as not to create noise disturbance, that would be much appreciated. But if you do want to ask questions, then please feel free to type these into the WebEx chat box and address these to the host, Adrienne, and we will go through these at the end of the presentation. The presentation will take about half an hour, and after that we'll take your questions. So just turning to some of the key themes that Abby will be talking about today. One of the main developments since our last webinar has been further decline in oil prices. The oil prices are currently trading around $60 a barrel, around half of what they were trading at during the summer. So forecasts have been revised down for oil prices both this year and next year, and Abby will be discussing some of the implications for our industry forecasts. But there are, of course, other developments that have influenced our forecasts that will also be discussed. The macroeconomic environment in some key emergers has deteriorated, namely in Brazil and Russia. And in the developed world, monetary action in Europe and Japan has weakened currencies in these countries, and the US dollar has also strengthened. So without further ado, I'll pass it over to Abby.
All right, thank you, Kieran. My name is Abby Sampson. I'm a senior economist on the industry side at Oxford Economics, and today I'm going to take you through the latest update to our international industry outlook. Generally, what we've seen since the end of the year is that the latest industrial news flow has generally been improving, but it's been far from spectacular. Manufacturing output in the Eurozone picked up once again, while Chinese IP rebounded after a mid-year lull. The core measure of capital goods output in the U.S., which is generally a proxy for future investment, had fallen for 4 consecutive months at the end of 2014, but we saw some rebound again in January. And at least in year-on-year terms, they are still significantly positive. But perhaps one of the biggest upside surprises we've seen over the last 3 months or so has been in Japan, where manufacturing output has risen quite strongly for 4 out of the last 5 months, following developments from after the tax rise in April. Most recently, in January, we saw a monthly growth of 3.7% in Japan. So just looking at the global industrial outlook, we're expecting a slight slowdown, this year in Q1 to falling below 2%. But by the end of the year, we are expecting a rebound back towards trend of around 3% next year. The most notable slowdown in recent months has really occurred in the U.S. The manufacturing ISM there is still pointing to significantly positive growth, but it dropped to just below 53 in February, which is the lowest level in over a year, and it's down from the 56 to 58 range in mid-2014. China's PMI also dropped below 50 again in January and February, but Europe, in contrast, has shown some improvement in the early part of this year, although it remains below the levels seen in early 2014. And again, although not shown on this graph, perhaps the biggest upside surprise has been in Japan, where the PMI has been considerably in expansion territory for some months. But there are some risks to the forecast. Our measure of global trade, which is based on the export component orders component of several key manufacturing surveys, and is generally considered a reasonable indicator for future trade growth, has been weakening in recent months, which may point to a bit of a slowdown later in the year. Now, just looking at our key forecasts for global industrial production, what we're expecting is U.S. IP growth to slow slightly in 2015. Now, much of this is on slightly lower extraction output, but there's some impact from the strengthening in the dollar, as we'll discuss later. The Eurozone industrial outlook is picking up slightly, spurred on by a weaker euro, but the recovery is not expected to strengthen in earnest until 2016. In Japan, the outlook is somewhat more positive on a weaker yen, but there's still some structural supply side issues, as well as weaker demand from its trading partners, most notably from China. So we expect a moderate uptick this year, but then slowing towards the second half of the decade. Chinese industrial growth is also seen slowing steadily through the end of the decade as companies there shift away from an investment-led growth model. And in Russia, production has been held back by the falling oil price, sanctions, and also currency and monetary policy pressures. So we generally see four key developments in the industrial sector over the last 3 months. The first most notable element is the steep decline in oil price underway since the summer. As Kieran mentioned, oil prices are currently trading around $60 per barrel for Brent and around $50 for WTI. And on balance, we see this as a net boost to global industry, although the gains will be uneven across countries and across sectors. However, countering this, the outlook in some of our key emerging market economies has deteriorated. The most notable deterioration has been in Brazil and in Russia, but also China is entering a soft landing over the next few years as it cuts back investment and eases its dependency on credit-fueled growth. In the developed world, there's been a bit of a shift between the major producers. Monetary action in both Japan and Europe have led to a subsequent weakening of both of their respective currencies, but the flip side to that has been the strength in the US dollar. And as a result of this, the forecast for Europe and Japan has been boosted somewhat, and the US has been pushed down somewhat, although I think we remain more cautious about the outlook for both Europe and Japan. While in the US, a strong domestic growth market should offset some of the impacts of the weaker US dollar. So now looking at oil prices, this has been really the most notable development since last summer. Not only have spot prices fallen sharply, but we've also downgraded our outlook over the medium term. And we're now seeing oil prices averaging just $85 a barrel by the end of the decade. On general, we see this as a net positive for the global economy. There's the transmission mechanism from lower oil prices to stronger growth is twofold. Directly, oil prices will feed through to production via lower costs, higher profit margins, and also assuming higher demand conditions, increased production and investment. But perhaps just as importantly, there's an indirect channel whereby a fall in the oil price boosts household purchasing power and redistributes income from large oil exporters to net oil importers. Previous work that we've done, we estimate that in the 10 largest developed economies, this should save about $440 billion, or about 1% of GDP in these economies, freed up for additional spending. So oil intensity varies widely across the economy. So in most countries, oil consumption is heavily concentrated in the transport sector. Industrial use is generally quite small. So in the US, China, and Europe, it's generally less than 10% of total industrial industry. And even within industry, oil use is highly concentrated. So in the US, for instance, there are just 5 sectors that contribute over 80% of total energy consumption. These are refining, which is not shown in the chart, chemicals, pulp and paper, non-metallic minerals, basic metals. Now, refining alone accounts for 25%. Because it's so much of an outlier, has not been shown in this chart here. Therefore, really only a handful of industrial sectors would benefit directly from a reduction in the input cost due to oil. Refining, as the most oil-intensive sector, one might expect to benefit, but in practice, refineries tend to be owned by upstream oil firms, so the impact on profitability upstream will offset some of the competitiveness gains from lower input costs. So the direct impact from lower production costs would be stronger in some of the other more oil-intensive sectors, such as the petrochemical sector. In order to quantify this impact, we've used Oxford Economics Global Industry Model to run a set of counterfactual scenarios based on what our oil price forecast was ahead of the summer. By mapping the subsequent changes in consumer spending and in fixed investment, as well as interactions through the supply chain, we're able to model the size of the impact across various sectors in the economy. Transport services, as can be expected from the previous chart, would be one of the most impacted sectors. This is particularly important in the air travel sector. This is particularly important to air travel, since fuel accounts for about 30% of transport costs, but other forms of transport, so for instance, seaborne freight, would also be impacted with a potential boost down the supply chain and through global trade. Now, since a large portion of the impact comes through from higher household spending, sectors exposed to that, such as the hotels and retail, would also see a particularly large impact. As discussed previously, the impact on manufacturing may come as a bit of a surprise given the relatively low oil intensity of the manufacturing sector, but this mainly would come through the indirect channel of higher spending in the overall economy. Now, the notable exception to this positive boost from oil is in the extraction sector, since lower oil prices would eat into firms' profit margins. However, the upstream extraction tends to involve large upfront capital costs. So given this, and once these investments have been made, the marginal production costs are relatively low outside of some key sectors of extraction. So the more immediate impact from the lower oil price on extraction should come through to investment, with impacts further down the supply chain to sectors such as heavy machinery and oil rigs. Now, within manufacturing, automotive production leads the way. This largely comes through from some of the second round effects because the drop in oil prices frees up disposable income to be spent on big ticket items such as cars, while the sector's dependency on fuel raises demand for some of the higher margin products such as SUVs or pickup trucks. There's a similar dynamic taking place in the aerospace sector, as a reduction in fuel costs will raise demand for planes from airlines. Both of these processes involve quite large, complex global supply chains, so there will be further boosts further down the supply chain to sectors such as basic metals, engineering, and to some extent electronics. Primary metals and chemicals, as quite oil-intensive sectors, also see a benefit. Okay, so moving on from oil prices to emerging markets. Countering some of the positive impacts on oil prices is weaker growth in key emerging market economies that have been previously at least a growing source of final demand for manufactured goods. GDP in Russia is seen contracting by 6% this year, and Brazil is seen broadly stagnating, while Chinese growth is seen dropping below 7% through the end of the decade. So what this is doing is cutting off what had been a rapidly growing source of demand for manufacturing goods. Our downgrade since our November update has been largest in the Brazilian and Russian economies. Brazilian GDP forecast has been dropped by almost 7 percentage points. Our Russian GDP forecast has been dropped by almost 7 percentage points, and Brazil's been dropped by about 1.5. However, that being said, these two economies alone are relatively small final consumers in the global economy, at least relative to large developed economies, as well as particularly relative to China. So perhaps a more important development for global manufacturing is an expected slowdown in Chinese investment growth in the near term, through the end of the decade, since Chinese investment accounts for almost 20 or more than 20% of global investment. Investment spending in China is expected to slow from 8.5% last year to below 6% in 2015, and then below 5% through the end of the decade thereafter, as firms wean off their dependency on borrowing. This will have implications for capital goods production not only in China, but also across the developed world. Japan and Germany stand out as highly vulnerable because both countries export a fairly large share of their total capital goods production to China. The U.S. looks somewhat less exposed, although this is only down to the lower export intensity of its production. And the UK, only the UK really looks much less vulnerable. As a result of this, global growth of engineering goods is seen slowing from 4% this year to below 3% in 4% in 2014 to below 3% this year. Now on to the recent developments in Japan and Europe. The monetary policy movements in both the Eurozone and Japan have led to sharp depreciations of both their respective currencies. The euro is currently trading around $1.10 per euro. That's down from about $1.40 about a year ago. And the yen is currently trading around 120 yen to the dollar, from around 80 yen to the dollar in 2011 and 2012. Moreover, we expect the monetary policy discrepancy between the two to widen through the course of the year, so this should put further downward pressure on these currencies relative to the US dollar. Now, as a result of this, we've boosted our export growth slightly over the last 3 months in both regions. But nonetheless, there are reasons to remain cautious about both regions. In Japan, we see slow investment growth, as growth in its trade partners, most notably China, will limit the extent of the upturn in the manufacturing sector there. And in addition, some sectors in Japan, such as the automotive sector, heavy investments have been made in offshore production, which is unlikely to be reshored quickly in response to the weaker yen. In the Eurozone, although we are relatively optimistic about the forecast there compared to other forecasters, we still think that capital spending is likely to be held back this year by uncertainties surrounding developments in Greece and in Russia. Now, finally, moving on to the U.S. The strength in the U.S. dollar has been the flip side to the weakness in Japan and Europe. The nominal trade-weighted exchange rate has appreciated by more than 11% since the start of last year. And conversely to the upgrade in exports in Japan and the Eurozone, we've downgraded our forecast for exports in the U.S. We think the stronger dollar will hit manufactured exports on the margin. But that being said, relative to other major producers, U.S. manufactured goods are largely, the U.S. is largely producing for domestic market. Only about 19% of U.S. manufactured goods are exported. U.S. manufactured gross output is exported. The rest is sent to a domestic market. And our forecast for domestic demand still remains reasonable. We're expecting fixed investment to grow business investment to grow in the region of 5 to 6% through the course of the decade, which should continue to boost demand, at least for domestically produced capital goods. So in summary, basically, globally, we've now seen manufacturing growing about 3.25% this year. That's a similar pace to its pace of growth last year, as the boost from the oil price has been offset by weaker demand in some of the key emerging markets economies. Globally, aerospace stands out as a strong growing sector, as the boost from oil price will lower costs for airlines and boost demand for airspace goods. And that will have some implications down the supply chain, for example, to sectors such as computers and electronics. Although that sector tends to be a relatively contained sector, and will receive a further boost from higher demand for new products, such as more connected devices as part of the Internet of Things. In addition, the chemical sector looks reasonably robust. This is in part due to the boost from the lower oil price in firms such as subsectors such as the basic chemical sector, which will have a particular impact on European firms, which tend to use more oil-based inputs versus natural gas inputs that are used in the US. Further down, we see some weakening in certain sectors, such as engineering and motor vehicle sector, reflecting some of the weakness in demand conditions. The motor vehicle sector in particular might look quite surprising given the recent developments in the oil market. But generally, we think that we see some of the demand conditions in the BRIC economies as dominating in motor vehicles. Anyway, that pretty well sums up our global view. I'm going to turn it back over to Kieran for any questions.
Okay, thank you, Abby. We'll just have a look at what questions are coming through. Okay. First of all, the first question is about industries that supply to the oil and gas sector. Mm-hmm. So someone's asking, is there any info on the negative impact on manufacturing for those companies in oil and gas supply chains?
Well, so that's a very difficult question to isolate, to look at in isolation, because all of the sectors are going to be wrapped up into higher level sectors. So, for instance, the machinery sector, some of the other transport sectors, and we're also not seeing where that is more apparent is in countries such as Norway, where the oil and gas sector is important. You do see those particular subsectors split out. There's not a huge amount of evidence of weakening as of yet, but that we're really expecting that to come through this year as investment weakens.
Okay. So the next question. Given that the US dollar has been rising, can other countries afford US aerospace products?
I think this is the thing about the aerospace industry is the supply chains for that are very global. So the value added is over 50% of the value added in aerospace is produced in the US itself. This is only really an influence on the margin, and also they're quite long lead times between orders and deliveries in the aerospace sector. So orders placed this year are unlikely to be delivered for several years down the line. This is also one of a slew of order backlogs is also quite a massive driver of some of the near-term strengths that we're seeing in the aerospace sector.
Okay. Okay. Another question is it meaningful to compare US export intensity to Germany's? Unless Germany only exports outside the EU has been considered.
Well, I mean, the point with this is that demand from the Eurozone, I mean, demand from the U.S. domestic market is much stronger than demand from the rest of the Eurozone. So although, yes, most of a good chunk of Germany's exports is intra-Eurozone, the demand conditions there are much weaker.
Okay. Next question. Do you see the lowered oil prices starting a deflation cycle somewhere? And if so, where?
Okay. This isn't something we see as starting off a deflationary cycle. The oil prices, I mean, the oil price calculation impact on inflation should drop out of the inflationary calculations next year. So although in the short term a number of countries are going to fall into negative inflation rates, we expect consumers and businesses to view this as temporary. We don't expect any of this to become entrenched in inflationary expectations.
Okay. One question relates to oil prices. So what are the underlying factors for shifting the oil price forecast downwards?
Okay, I'm actually going to hand this one over to Kieran because she's our commodities expert and would be better at answering this than I would.
Okay, with regards to our oil price forecast, I believe you're probably referring to the medium-term shift downwards that Abby mentioned. This came about as a result of our reviewing our forecasts in light of marginal cost of production. And so we revised down our forecast. So by 2020, we're now talking about oil prices being at about $85 a barrel. Okay. Just one more question. Okay. Someone's just asked if in our industrial production forecast, if we adjust for a leap year, or is the Eurozone uptick in 2016 linked to a longer year?
Well, Eurozone data, I believe, is seasonally and working day adjusted, so that should be adjusted for in the underlying data.
So I think that wraps up the questions. Thank you all very much for listening, and we hope to have you back again in early June for our next webinar.